So if your income is down or is down compared to the year before, and you're paying in early these estimates, being $15,000 overpaid at the end of the year when that money could have sat in a CD or something and made 4 or 5% during the year, make your money.
Right.
So, and even to that extent, if your income is higher than it was prior year, pay the minimum that keeps you from having any penalty. Understand you'll owe in April, but, owe without any penalties and make interest on that all year.
Right.
Don't give it to the IRS early if you don't have to.
Ben DeNault, CPA, Stonehouse Tax and Accounting. One of my partners in that business. You work with us pretty detailed on the investment side as well. It's great having you and the investment planning office all together. I think it does a better job for our clients. Question for you, though. It's the end of tax season. Folks either got good news or not so great news.
Yeah.
Either way, hopefully their taxes are done or on extension, whichever the truth was.
Right.
Now, a lot of us that go through tax season say, hey, I have some, oh, darn it moments or some things that bit me, or I had some things that were fortunate. But ultimately, they're always kind of thinking, and probably you're giving advice like maybe next year you could do a couple things a little bit better,
right,
more organized, things like that. So let's talk about a couple of those things here. So I'm going to rapid fire you some questions.
Yeah, that's fine.
Let's just talk about, start off with investments, because that's something that we do a lot of. Sometimes people have capital gains or they get hit with some earnings that in jumps their income tax bracket up in a given year. And then that kind of throws their estimated payments off. So what do you usually see and what do you usually recommend on year to year?
Yeah, in any given year, you can have unusual stuff that's not going to come back, right? As a baseline, when we're doing our estimates, we focus on this year's tax because we don't know what next year is going to entail. So, we'll take this year's tax, usually 100%. If you're a high earner, 110% over 4 quarters, there's your estimates, right?
Okay.
If you have something unusual that you're not going to have next year, make sure we know, right? Because you could be paying way more in estimates than you need to be paying. So, if you have recognized a large capital gain, if it's our first year doing your return, we don't know that that's not your normal unless we're working with your investment advisor all the time.
Right.
But if we're not, and you have that, unless you tell us, we're going to do your estimates based on this year's return, right? So anytime you have anything unusual, make sure we know about it so we don't have you spending more than you need to during the year. A good example this year for a lot of people is the royalty income.
Right.
You're probably going to have to check back in with your advisor in June or September and say, hey, these estimates you gave me seem like a whole lot compared to the royalties I'm getting this year compared to last year.
Right.
We're not going to know until we're into the year where they go, but right now it looks like it's going to be down. So.
Yeah, and those things work completely opposite of each other, right? We have no control over the royalties, and most clients have very little maybe knowledge about what's going on in that portfolio, investments, and what might kick off the gain. So about communication, right?
Yep.
Mid-year, it's not unusual. I know we get requests for the folks that pay attention and want to pay attention. We get requests to, or we're proactively reaching out and saying, hey, here's, halfway through the year, here's what it's looking like. I know in the fall, we really start to pay attention to the gains or losses in the portfolio. Oh, more of the gains we like to talk about.
Yeah, right.
But we try to take advantage of those losses too, and make sure that the accounting professionals know what's going on. So one arm's talking to the other. Yeah,
it's hard. Like you said, when you get into the fall, you really get serious about if you need to tweak those estimates. Your first one is pretty much due when you're setting your tax return in, right? And, if you're filing a little earlier in the season, you might have a month to where your next estimate's due, but there's not a whole lot of time to figure out what your whole year is going to be. So the first one usually just goes in based on last year. Sometimes June is the same story, but that's September one and the December or January, whenever you like to pay it.
Yep.
Yeah. Adjust that one if you need to.
So I'm going to give you a segue into the next question then. So why do I care about adjusting it, right? What's the big crime in paying I shouldn't say crime.
Yeah.
It's like a word we're not allowed to
No
say.
crime. IRS is happy to have your money early.
Yeah, exactly. What's the big dilemma there? What issue of paying too much ahead of time?
Yeah. So it didn't used to be a problem, but right now you can earn really good interest.
Right.
Right. Interest is back again.
Right.
We'll see how long, but it's back. So
for 2023, it certainly is.
Yeah. So if your income is down or is down compared to the year before, and you're paying in early these estimates, being $15,000 overpaid at the end of the year when that money could have sat in a CD or something and made 4 or 5% during the year, make your money.
Right.
So even to that extent, if your income is higher than it was prior year, pay the minimum that keeps you from having any penalty. Understand you'll owe in April, but owe without any penalties and make interest on that all year.
Right.
Don't give it to the IRS early if you don't have to.
Well, how much does the government pay you for giving them a loan for that period of time?
Nothing. Yeah, nothing.
Exactly. Right?
So it's they'll pay interest if you have a refund coming late. If they take time to pay you, they'll pay you interest, but they'll penalize you for underpaying your estimates. So you do want to make those, especially they raise the penalty to match market interest rates, so that's increasing as well. So you pay the minimum so you don't have any penalties, but I wouldn't pay any more than that while you have the opportunity to make some interest.
Yeah. Well, so you're mentioning royalties and taxes. And another thing that triggers in my mind is a conversation we've had a lot on the investment side. People that are getting royalties, one of the easiest default recommendations we give them is if you have access to a work retirement plan, through your employer,
right.
Even if you're self-employed and you're doing something or you haven't done something yet, really consider doing that because it's going to help reduce your overall taxable income, right? Pushing money into a retirement plan.
Yeah, absolutely.
If you're getting royalties.
Yeah. So, if you're, average person out there with your W-2, you have your budget plan, you know what your take-home pay is, and now you're supplementing this with more royalty income. Well, if you were comfortable with that pay rate before, max out the retirement because you're supplementing with the royalties and get back to that same point. Give yourself a little more, however it works out. But yeah, you should definitely bump up if you're supplementing your income and defer some of those wages and invest in yourself that way. Yeah,
it's a little bit jarring. And we've talked to folks that look and a good number of them have maxed it out, right? But when you max out, there's some big room in those plans that more than there used to be 5 years ago. So the limitations, the caps on how much you can put in retirement have been increased.
Yeah, it's a lot of money every year.
People, I'm not saying me, but people 50 and up
right.
can do catch-up provisions. So you can really push a lot in there. If you're solo, if you have a small business, you can do a solo 401k and other plans that allow you to put 30, 40, or 1,000 or more into those things. You can really be creative with those if you have the ability, if you're getting those royalties, if you have that ability to kind of rebalance. You're still getting the same spending cash, right?
Right.
In most cases more, but you're just paying less in taxable income.
Yeah, and to that point, if you're simply just making good money, regardless of the royalties. And, a lot of people set up their default. They enrolled in their plan. They set themselves at 10% and, haven't looked back.
Yeah.
Well, if you're making really good money and you're having good take home, consider upping it, get closer to that max.
Yeah.
If you've got more take home than you necessarily need, then that's great.
Yeah.
And you don't have to do it on every paycheck, right? If you're getting into November and you say, hey, I'm really good on cash. I was going to do something, but instead of that, tell HR to up your retirement contribution through the rest of the year.
Mm-hmm.
Yeah.
It's hard to see that your take-home pay go from this down to this.
Right.
But really you are saving. You're putting more in your pocket. Right?
Yeah. I mean, the
tax liability.
Yeah. You're completely deferring that wage out of taxable wages.
Yeah.
So
I want to get geeky, nerdy with you here because one of the topics we talked about is we're up on the northern tier of Pennsylvania, right? So we deal with a lot of folks that are over the border working in New York, living in PA or vice versa. So talk to me about the state taxes. A lot of people sometimes find themselves not realizing that one state was charging and not charging and things like that. So what are the most common issues you have with people that are in both states?
So yeah, probably the most
Try
common.
to keep it as simple. It's kind of
Yeah, I'll do my best. Yeah, probably the most common one is your Pennsylvania resident working in New York.
Right.
On those retirement contributions we just talked about, New York does the same treatment as the federal. They reduce your taxable wage. Pennsylvania doesn't. Right, and you're going to get one W-2, and it's just going to show that New York wage. And the common issue I see people do is put that New York wage on as their Pennsylvania wage too, and they don't add that retirement contribution amount back into the Pennsylvania wage.
Okay.
And they end up short on their PA wages, and they get that letter in July, and then they have to deal with that whole mess, right? And it's an easy thing to do if you know it's there, and that holds true for your local return as well. It's the reason that is because PA doesn't tax your retirement income. Right. So they tax the wage up front.
Tax it on the way in.
Yeah. So they don't tax it when you pull it. They tax it when you make the wage. But if it's a New York wage, they're not going to tell you with your W-2. You have to know that you have to add that back.
Isn't that beautiful?
Yeah.
I love it. Every state does everything differently.
Yeah. And then there's a credit, right? You're going to have to report those wages to New York State, and you claim a credit for the taxes you paid to New York on Pennsylvania. Okay. People forget that credit, and they pay tax in both states. So definitely don't do that. That gets expensive in a hurry.
Okay. All right. Anything else on the state?
Oh, there's lots of stuff on the states, right? I mean, they're so. That's the strange thing about taxes, all the different state laws, right? But to dive into all of them, we probably shouldn't. One big one for Pennsylvania, if you're putting money in the kids or grandkids' 529s.
Yes.
That's not a federal deduction, but don't forget to take it on your PA. Mm-hmm. It's only 3%, but if you're putting a good chunk in there, then make sure that's on your PA return.
Right.
Yeah.
We talked a little bit about depletion the other day, but so that's a federal thing, right?
Yeah. Generally, we're only taking that on the federal return.
Right. Depletion, I should say, against your gas royalties.
Right. 15%. Yep.
Okay. Most people are getting that right. Correct. You don't see.
Your local preparers are.
Yeah.
Yeah. I wouldn't recommend you go out of state to a preparer that has no idea about natural gas royalties to have your return done. When those come in, the depletion often isn't there.
Right.
But our local preparers here, they've all been handling the royalties for years now. So I don't see that missed very often. Self-prepared returns, I see it missed because it's not something you would know unless you've had to do it before.
Look, how about just real and in general, organization, the way people, do people still come to you with a shoebox and receipts? And everything?
Yeah.
All right. I thought that was the whole thing, but
no. We try to tell everybody that does that. You really don't want to pay us to add,
right?
And that's what it is. We're sorting and adding. You really should do that at home and give us totals. Keep your receipts for yourself. We can do it for you. Some people need the help. But some people just don't want to mess with it. You're just making your tax return so expensive. And that first part of it, it's just sorting and adding. You can do that at home. We encourage that strongly. Right.
I would say, from my personal experience working with CPAs, it's great. The CPAs, in my opinion, always pay for themselves and way more because of not just good tax advice and opportunities and understanding how to use this and offset that, but also just there's just a sort, I won't say serenity, but there's just a calming effect that you guys have. You're used to dealing, like when you just said the state sends you a letter, says, you overpaid, underpaid, or whatever. People get a letter from the state Department of Revenue or the IRS, and they get agita and they start to skip a beat.
Sure.
And then, you guys are always like, oh, those, that's a normal thing. Just do this, or they're just looking for this piece of information. Just, but ultimately when it comes down to, ever being audited and examined, I think it's important for people to understand. I'd love to hear your insight on this, that ultimately it's the taxpayer, right, who has to defend that position. And the accountant is only as good as the information provided to him or her. Right. Yeah. Yeah. So you got to save those receipts.
Yeah. Yeah. Save those receipts. We can help you formulate your response, but when you get audited, they're looking for the source documentation, right? What's your source document? What proof do you have of this deduction? It's usually the ones I see are around charitable contributions. you put your all your goodwill stuff and everything on there, the number gets a little bigger than it ought to be.
Mm-hmm.
They'll come say, how'd you arrive at these values? Right. If you can't do that, it's probably not worth trying to take it, at this point.
Yeah.
But yeah, the other receipts and everything, you keep them. Now, the most common, when people think they're being audited, it's usually an information request.
Okay.
We call it the CP 2000 letter.
Yep.
It's literally, the IRS has a pretty good matching system now. And they'll send you a letter that says, this is the numbers we have. These are the numbers you reported. And you have side by side and you can see, oh yeah, they're saying that I reported I had $1,600 in estimates. They only have $800 in estimates. Let me go check. And they're usually right.
I was just going to say that.
And you just, there's a little voucher that you can check that you agree with the change and include your $800 check, and on you go with your life, right? I mean, generally, it's not that tedious of a process. If you get into a small business return and they're auditing that, yeah, you're going to want your receipts to send them for what you have in your repairs and maintenance account, right? If you don't have any of that supporting stuff, then they'll disallow deductions.
Right. And I think that's what I want to avoid. Like, people that go, their accountant says, hey, what did you spend on X? And they go, oh, $2,500. Right. And they're just throwing the number out of their head, right?
Right.
And if that ever comes to light where you have to defend that, you have nothing, right? Then you can't look at the accounting firm that did your taxes and say, hey, you left me out to dry. They gave you a number that had no backing.
Yeah,
right?
we're not your auditor. So if you give us your numbers to prepare the return with, we're going to use those numbers to prepare your return with, right? And we have to be able to trust you to do our job. So when that time comes, and if you can't find the receipts, then they're going to throw it out. Yeah. And then you'll pay the difference in tax and you'll move on. Hopefully it's not to the point where they think you're being negligent or, you have the accuracy related penalties. Don't get into that. Right. But if they come in and they adjust some expenses out, then you pay the difference and go on your way. But yeah, you want your receipts.
So receipts, what about, this is a good time of year for, as I mentioned, when we open this up, everybody has good intentions. They kind of maybe struggled to get those receipts around and everything more than they thought they would. And it took longer and they forgot where they stored something. But ultimately, are there any tips for reorganizing or getting better? How about electronic? Are you seeing more and more people going
That's
electronic?
The biggest tip. Yeah. Is get yourself a desktop scanner.
Yep.
Once a month, run them through. Save them in a receipts folder. Done. Right.
$250, get a scanner, look at your computer, store it on a hard drive.
I think it's important, especially since a lot of the receipts people have, if they come on the calculator type paper, those things are good for 6 months to a year.
Right.
Tops,
and
they fade and the ink goes away and you'll be handing them a strip of calculator tape with next to nothing on it. Right. So scan them through while they're fresh because they don't last otherwise.
Right.
And the nice thing about that, if you have it backed up and stored, then get rid of the paper.
Yeah.
You don't need it.
Right.
It's just clutter.
Yeah. That's a great idea. In fact, that's my last question on the individual taxes is, how long do we get this question all the time? Right? How long do I have to keep all this stuff? Right.
Yeah.
Well, it's a lot easier if it's electronically stored.
Right.
Right.
Absolutely.
But ultimately, what does the IRS say for individuals?
So really, it's 3 years. We say 7 anyways. There's some...
That's a big difference, man. Why is that?
Well, there's some things you would want 7 for, claiming old losses or securities that went to zero that you claimed losses on. There's some things where they could go back a little farther. And it's just nice to have a little bit of buffer, I guess.
Sure.
But before you throw tax documents away, if you're not keeping them electronically, something I like to remind people of is you should check your Social Security transcripts first.
Why is that?
Sometimes they miss wages.
Okay.
So if you go back through, my old partner had this, I had a year in 89 where they didn't have his income. And he was able, off of his documents, to submit that to Social Security, and they updated his transcripts.
Interesting. Okay.
So it would be worthwhile if you're sitting on 25 years of tax return data and hearing this going, honey, we're clearing out the shed this weekend, right? You can hop on socialsecurity.gov and you can check your transcripts and make sure you don't have any gaps in your earnings history that don't make sense to you, that you can hop back in your tax docs and get that straightened out before you get rid of that stuff.
That's really good advice. And we often instruct folks on how to get onto the Social Security website, get on that mysocialsecurity.com.
Yeah.
See all the history of your earnings. So that's great. Having not seen any blanks, I didn't even think about that, but
Right.
I'm sure they happen.
Yeah. And once in a while they do. And, it could be something as simple as your employer in any given year didn't submit your W-2s right.
Right.
Right. So they're supposed to all get filed where they need to go. Sometimes they don't. So
I would think that would be the problem because the government never makes mistakes.
of course not. Yeah.
Absolutely. All right. So that was mostly all individual stuff, mom and dad, our tax returns, right? A lot of folks that we work with have small businesses. So let's just shift a little bit to,
Sure.
Coming out of tax season, small businesses. One of the things I know we hear a lot about, and I'm sure you get hammered with this question all the time, is like, should I be an entity? Should my business, maybe it's just me, my spouse and I, or 4 of us or whatever.
Right.
Been doing it as just this, side
sole proprietor gig.
Yeah, side hustle. But, people tell me I need to do it for, a lot of times I hear for liability reasons, but there's some big tax advantages to becoming an entity and managing that entity the correct way. Right. So let's talk a little bit about that.
Yeah. So not everybody needs an entity, right? I mean, if you're running a tiny little side business, then no, if there's no real liability involved, like you said, there's liability concerns. So some things are perfect as sole proprietorships. A lot of times the LLC is a really good fit for multiple reasons. And then there's generally the general practice now is to start everybody as an LLC,
right? If
they want to be an entity, because that gives you the flexibility to elect to be whatever you want later, partnership, S-Corp, or stay just on your sole proprietorship. You can do all 3 through an LLC. So that flexibility is why we go that route. Just real quick differences. If you go the S-Corp route, you can put yourself back on payroll. That's one of the big benefits. People miss that steady check.
Backing up from that. So let's say I form an LLC for multiple reasons, right? Now you're saying there is another step, right? Like on how you want that LLC to be taxed.
Right.
Right. So there's an election to be taxed as an S-Corp.
Correct. Right? Yeah. You start
You're
the
not
LLC.
Automatically an S-Corp.
Exactly. Yeah. You start an LLC. If you started as one individual and as a sole member LLC, they call it.
Yep.
The IRS calls that a disregarded entity.
Okay.
You're still reporting right on your individual income tax return on Schedule C like you always have.
So the real reason for doing it and being a sole member is ideally like liability, right? It really limited liability. That's a big reason, right?
Yeah.
But your taxes are really just the same old taxes. You're just reporting the income through.
Yeah, you haven't changed anything yet.
Yeah. Okay.
Tax wise, if you've done that, right? But then from there, you either file an S-Corp election form, or you can file a change of entity status to become a partnership.
Okay.
Now, you would only do that if you brought in a partner.
Sure.
Right? The
Makes
S-Corp
sense.
you can do on your own. The partnership, if you brought someone else in, you'd elect to be a partnership if you don't want to do payroll.
Okay. Now, and I'd like to dive into that because we talked a little bit ahead of this. There's some real advantages or gains and opportunities for an individual, a business owner, being taxed as an S-Corp to pay themselves in a certain way that they can take advantages of the brackets and the Social Security tax. So let's dive into that. I think we'll probably end up putting numbers like right here on the screen or something.
Yeah, right. We'll put something up for this part. But so one of the great things about the S-Corp is, like I said, it lets you put yourself back on payroll. Mm-hmm. So good steady cash flow. You have a W-2 again. That's nice, right? The profit above and beyond your payroll passes through to your return.
Yes.
On your individual return. As a sole proprietor, you have no payroll. You just pay tax on that whole profit.
Yep.
Right? Subject to self-employment tax. And the S-Corp, the wages are subject to Social Security, Medicare taxes, but that passed through portion is not.
Right.
So you can reduce some of your Social Security and Medicare tax burden, which is 15.3%.
All total.
So, yeah. So it's not a small amount of tax.
Right.
It doesn't take long for that to really add up. You do have to take a reasonable wage. So don't hear me saying you can start an S-Corp and take a $5,000 wage and not pay any more Social Security, Medicare taxes.
Right.
That's not, you need to pay a reasonable wage. But if you have a business that's making $100,000 to $200,000 a year, and you pay yourself a good reasonable salary, that savings above that wage up to the Social Security limit can be a pretty substantial tax number.
And Social Security limits pushing 140, a little
160 for 2023.
Oh, that's right. Yeah,
they really bumped it up.
That's a
year.
big jump.
Yeah.
Okay. All right.
Yeah.
So using rough numbers, if you're earning 200,000,
right,
you could set your salary. Now you say reasonable salary. That would depend. It's just not. The IRS will never say this is a reasonable salary at this amount, right? So you have to set that, and it also would depend on whatever the heck your industry is, right?
Right. So that they haven't come out and prescribed, based on this much profit, you need to take this much. That hasn't happened. I don't think it ever will.
Right.
But kind of a rule of thumb is, what would you pay someone else to do this job, not including ownership incentives and all that kind of stuff, right?
Mm-hmm.
What you pay yourself is not what you would pay someone else to be a manager of your store or something like that. Maybe you're taking home 150, but you would, if you shopped that out, you would only be paying someone in market rates at like 85.
Okay.
Well, your salary should be 85 then, right? You shouldn't be doing this higher number,
right?
And you can save the Social Security Medicare tax on the difference.
Which would be, in this example, like $80,000.
Yeah, I mean, so you have $80,000 profit at 15%.
Yeah.
So that's pretty significant. 12,000 if I've got good head math.
We'll check the math back in the lab.
Right.
Okay. Yeah. So and you see, do you see people having that set up but don't actually adjust those numbers to take advantage of that?
Yeah, I do. I do. And the other thing to keep in mind is that profit that passes through right now gets a 20% business income deduction. So if you pass through 100, you get a $20,000 deduction.
Right.
There are some phase outs there, but most businesses are okay and don't have to worry about the phase out. They have enough wages, but don't give away that deduction either.
Mm-hmm.
If you take it in wages, it's wages. It's all taxable.
Yeah.
The pass through portion gets 20% off.
Okay. So
plus the Social Security savings.
That's what you just described probably pertains to a huge majority of your small business clients.
Yeah.
Right.
Sure.
Yeah. So
the S-Corp is very popular, and most just do the reasonable wage, but I do see some come in that are either doing what you're not supposed to do, that are taking like a $15,000 wage.
Right.
That's pretty frowned upon.
Yeah.
Or they're maxing out the Social Security, or they're taking even more than that.
Yeah.
So
we talked about this the other day. So some folks have no problem maxing out that Social Security because they feel like it's going to automatically build them a pension, right?
Right.
And future Social Security benefits. As a financial planner, I take a different spin there, and I'd rather you do what you have to do. Like you said, find that good balance, that good range, that reasonable salary, set it there. And the rest of that money, you can really set up a heck of a nice retirement plan on your own.
Yeah.
You still have Social Security, but then you can hedge, more into retirement on your own through solo 401ks, simple plans, SEP plans. There's all these different acronyms out there, but there's a lot of flexibility for small businesses these days.
Yeah, and you're an S-Corp with wages, so max out your S-Corp's 401k, right? Yep. So it's you can do the individual retirement plans like you said, but if you're an S-Corp with payroll and you don't have a retirement plan, you're really missing out there as well.
Yeah.
So.
Last thing on that, almost last thing on that, because we're seeing a lot of it on the individual side of our planning right now. We're ending quarter one of 2023. Mm-hmm. And as you mentioned earlier, interest rates have gone up substantially, and there's opportunities to have your money on the sidelines, which had been earning less than 1%.
Nothing. Yeah.
Is now earning 4 or 5% easily in this current moment. And, I know we are, so I'm assuming on the accounting side, you're seeing specifically small business clients, right, who have a lot in cash.
Sure.
And probably are so busy doing all the stuff they're doing every day to make money, they're not really taking a good look at what they have on the sidelines, where it could be earning an extra $5,000, $10,000, $20,000 of cash flow for them to use on whatever they want, right?
Right. Yeah, I mean, we never tell our businesses to throw their operating money in the market, right?
Oh yeah, right.
But you don't have to.
Right
now, you don't want operating funds at risk, but FDI insured stuff out there. I mean, sitting on cash right now is real opportunity cost for sure.
Yeah, and with the banking headlines and everything, we have seen at this point in time, I mean, who knows what tomorrow's news brings, but at this point in time, we've seen depositors with large amounts in, Silicon Valley Bank, which they were way past those FDIC limits, but they got backstopped, right?
Right.
There's just not enough backstopping to take care of every bank, right? So FDIC insurance, when times are good, no one ever thinks about it or talks about it. But when times get a little scary, people start paying attention. But in today's day and age, there should be no reason you can't keep all your money safe, get whatever you want to be FDIC guaranteed in the right spots, and still have very easy access to it to keep your business running, keep your cash flow going. You don't want to lock it up. Don't want to put it in the market. Don't want to risk losses and things like that. But if you want it safe and you take a little bit of time to look around, I know we're helping people get it spread out and get that coverage where they want it, get some good rates, and just a little bit of homework goes a heck of a long way these days. Yeah. Right. Yeah. So you're seeing that on, and even the personal side, right?
Yeah, of course, on both. It's nice to see again the sitting on cash and building cash inside the businesses. It used to be years ago that the business's cash could generate some more cash,
right?
But you can't put your payroll money tied up in an asset that might fluctuate. Well, these don't, right? It's interest and principal. So
and there's a lot of ways to design it for people.
Yeah. To let your business equity grow some for you is a good opportunity again.
Yeah. I love this job. There's a lot of fun stuff to do. Last but not least, whether you're an individual, like we talked in the beginning, or you're a small business owner, or you're both, right? A lot of them are both. Talk to me about, you've had now a couple of years of working alongside our financial planning office, and we share a lot of joint clients, but not all of our clients. We have different clients too. Talk to me, in your opinion, about the value created when the tax hand talks to the investment or the financial planning hand.
Yeah, it's.
I surprised you with that question, but I figured you could talk about it.
No, it's invaluable, really. I mean, the ability to just have a quick phone call of, hey, our client wants to do this. Does it mess with any of the goals that you have? Right. I mean, generally it's a no. You're good. Go ahead. But at least you had the conversation, right? Because it does happen that, someone that's on a plan to come in at a 0% capital gain rate, we'll talk to each other and say, oh, well, do you know they sold the rental house this year? Right.
Yeah.
and oh, well, no, shoot, we're going to sell less stock so that we don't end up making all of this taxed at 15% when it doesn't have to be.
Yes.
So, just having some quick conversations on what's going on is a big help.
Yeah.
So if your people aren't communicating, it's not a good place to start.
Yeah. And I think we both work in a landscape in an environment where the landscape changes constantly, right? The new tax laws come out and new investment issues come out. And so we're always trying to just do what's in the best interest of the client. And then sometimes, though, you don't know that there was a rule changed over there that completely changes what we were just recommending. So having that knowledge is it's so easy to get that answer if the communication's there.
Right.
And I know that we work with a lot of accounting firms that are not Stonehouse, right? But the communication is there. So it's still a seamless, effort.
Right.
But, I know it can overall, it just provides, I'm so biased on this, right? Because I'm all in. You and I are both we're all in on these companies and how they work. And so, people, it's a shame that people aren't having those pieces of their life talking to each other. I think because it could create, higher taxes and less efficiency toward their overall goals. Right?
Yeah. And it's three parts, right? It's you as the advisors, us as the accountants, and then your attorneys.
Yes. Keep them involved.
You can't forget your attorneys, because your attorneys will go do stuff for you that costs you taxes too. Not to call out attorneys, but
or save you taxes.
Yeah, right. Sometimes, but it's important.
Right.
And whenever you're doing anything with your finances, run it past all your people and make sure that they've talked to each other.
Yeah. It's our job is to be working for them. So we should be paying attention.
Right.
Yeah. Anything that we forgot? I promised you a brief talk, and so you get back to work.
That was brief. Back to tax land. Yeah.
Okay, Ben DeNault, thank you very much. Ben DeNault, Stonehouse Tax and Accounting, and this has been valuable. I hope people got a lot out of it, and I'll probably call you back in for another one.
Sure, I'll
All
be
right.
here.
Thanks.
Thanks.